If you're a business owner and you think you only pay 2 taxes, income tax and capital gains tax, I'm sorry to tell you, but you're wrong. There are 6 different taxes that are eating away at your wealth, and most business owners don't know they're there and they don't plan for them. And the worst part is, most of them don't even show up until you're successful. Because the better you do, the more complex and layered your tax exposure becomes. Today I'm going to walk you through the 6 taxes that every business owner pays and how smart planning can turn surprise into strategy. So here we go. The first one is the obvious one, but still misunderstood: income taxes. This is either your W-2 wages if you have a corporation, or just your owner compensation if you're just a sole proprietor that puts it on a Schedule C. This income tax can be both state and federal. Some states don't have income tax, and so it won't show up on your state income. Others do, but all of them are going to show up on your federal tax return. Now, you're probably aware that the federal income tax is on a marginal tax bracket system where you start out at 10, and then anything above 10 is taxed at 12. Anything above 12 is taxed at 22. Anything above 22 is taxed at 24. Anything above 24 is taxed at 32. Anything above 32 is taxed at 35. And anything above 35 is taxed at 37%. That's how a marginal tax bracket works. So if you make 100,000, some of it's going to be inside the 10, the 12, and the 22. And if you make $1 million, it's going to go through all of those tax brackets. So whatever bracket you're in is not your effective rate. That's the marginal rate. Your effective rate is going to be taking all of your taxes compiled together, and you'll either hear it as an average tax or effective tax, but it's typically not the same number as whatever your marginal is. Another thing in this that most people don't understand is that your cash flow does not necessarily equal your tax bracket. There are other things that you could pay for that goes more than what you paid towards your taxes through like depreciation and things like that. So most people will look and say, oh, well, I had this much money come through my bank account, I should owe X in taxes. When in reality, there's going to be some calculation that goes on. It could be more or less than that based on if some of the expenses were not things you could write off, or if you had some sort of depreciation that allowed your taxes to go down quicker based on something like buying a car where you get some bonus depreciation. So cash flow does not equal taxes. Now, this tax is one that you don't necessarily feel as hard because you pay it every paycheck, every year. You know it's there, but you don't feel it as much because you're so used to it. The second one is capital gains tax. I like to call it the event tax. Typically, some sort of event occurs for you to owe capital gains tax. It could be a sale of a real estate property. It could be a sale of your business. It could just be a sale of crypto or stock. But some sort of event typically happens to bring on this tax. Similarly to the income tax, this is on a marginal bracket as well. It starts out at 0, and then it goes to 15, and then it goes to 20. But this bracket works with your income, your ordinary income, to work together. So if I make $100,000 of ordinary taxes, that's where I start with my capital gains. I don't start at 0. I start at wherever my ordinary income is, and then it goes up from there. My capital gains is not going to affect my income taxes, but my income taxes will affect my capital gains. Now, with capital gains, it's typically where you have cost basis and then you have actual value of a sale. So let's say I bought a real estate property for $500,000, and then I turned around and sold it the very next day. I made no improvements, nothing like that. I just bought it for $500,000, and somehow the next day I sold it for $600,000. I'm not going to owe $600,000 of capital gains. I'm going to owe capital gains on that $100,000. And in this scenario, it's going to be short term because you have to hold on to it for 12 months. Now, those brackets I was talking about, the 0, 15, and 20, those are for long-term capital gains. Short-term capital gains actually go towards whatever your income is, whatever income bracket you're in. So when I talk about the 0, the 15, the 20, we're talking about long-term capital gains. On capital gains, the whole value does not necessarily mean that it's going to be something that you're taxed on. Let's say that I buy a piece of real estate for $500,000 and I sit on it for 1 year, and now I'm at that long-term capital gains and I sell it for $600,000. I made no improvements, nothing like that, no depreciation. I bought it for $500,000. 1 year later, I sold it for $600,000. I don't owe capital gains on $600,000. I owe it on the difference between my basis, what I put into it, and what I sold it for. So $500,000 and $600,000. I would have a capital gain of $100,000, and depending on what bracket I end up, it's going to be 0, 15, or 20. One of the things I see most business owners get caught up here is that they forget about long-term versus short-term capital gains. Most of the time, your short-term capital gains is going to be higher than your long-term capital gains. You tap out at 20% on capital gains, and most people's tax bracket is 22% or above. So it's very rare that you would ever have more capital gains owed than your income. So you're typically always going to want to have long-term capital gains. So one of the biggest mistakes I see people make is that they sell things too early when they could just hold on to it for another month month, another week, and not have to pay those capital gains. For instance, right now we have a business owner client who needs some liquidity, and he was going to take money from his Schwab account that we're helping him manage. And I told him that rather than selling right now and sending him the money, I'm going to wait until March 4th before I sell it and send him the money, because he is going to pay less taxes that way. He didn't need the money right away, and if he did, we could borrow it some other way, but we're trying to make sure that he does not pay high taxes, and we're keeping it in those low long-term capital gains rates. The third tax that most business owners pay that they don't realize is the net investment income tax. This is a 3.8% tax that is taxed on income above $250,000 if you're married and $200,000 if you're single. And this is going to, just like capital gains, be based on your income, your ordinary income, and your capital gains income. So if I make $200,000 and I have net investment income of $100,000, the first $50,000 of that is not going to have this NIIT, but the second $50,000 is. So on that, let's go back to my real estate deal. Let's say I have $100,000. The first $50,000 is only going to be taxed at that 15%, but the second $50,000 is going to be at 18.8% because I have the 15% of capital gains and the 3.8 of NIIT. And most people aren't aware of the NIIT. Very few business owners that I talk to understand that they do potentially have to owe NIIT. Now, this is on passive income. So if you are actively engaged in your business and you sell your business, you should not owe NIIT on it. Now, if you have stocks, real estate, something like that, you'd still owe on that. But if this is on a business that you own and you are actively working in it, you work over 500 hours or you work more than anybody else. Let's say you have a side gig that you sell and nobody else is in it, or you do have somebody else, but you work more than them, you can on your taxes not owe that NIIT. But there are a lot of times that business owners will own real estate and sell the real estate, and they don't understand why they paid more on the real estate than they did on their business sale, and it comes down to NIIT. And this also comes down to being very good about noting how much time you spend in your business, so that if you ever get audited by the IRS, you can show them that you are an active participant in the business and that you're able to not have to pay NIIT. The fourth tax that most business owners forget about is the self-employment tax that they pay themselves. Now, if you're an S Corp, this is only on your W-2 wages. If you are a C Corp, it's only on your W-2 wages. But if you are self-employed and a sole proprietor, it is on all of your wages. You'll pay 15.3% on those wages. Now, you do get to deduct some of this when you file your income tax, but as a business owner, many of them forget about this at the end of the year or on their paychecks, and they wonder why they paid more taxes than they thought they were supposed to. They forget that as the employer, they pay taxes, and as an employee, they pay taxes. And in the form of self-employment, they kind of bundle those together. There are many ways to try and pay less self-employment taxes. I've come across business owners who had their company as a sole proprietor, paid themselves $1 million, and ended up paying self-employment tax on the whole thing. This is where entity structure can become a huge benefit, because you only pay Social Security taxes on the first $184,500. This is why many of your friends may have an S corporation, because it allows them to pay lower self-employment taxes than if you just had a sole proprietorship and you paid yourself on a Schedule C. Now, there are reasons to have one over the other, and it's important that you talk with your CPA or your advisor on which way is best for you. But many business owners don't think about this, and they end up paying way more self-employment tax than they really should. So you should make sure that your entity structure is the right one. Now, the fifth tax that every business owner pays is estate taxes. These are the ones that you typically aren't going to pay yourself, but your heirs are going to be the ones paying it. Over the last many years, this amount has gone up and up and up. But if you're a business owner, you're hopefully going to some point have a net worth that's high enough to have to owe estate taxes. In 2026, President Trump moved that up to $15 million per person, or $30 million for a household. So you have $15 million, your spouse has $15 million. If you have a net worth that is over $30 million as a couple or $15 million individually, any amount above that has a 40% tax. And some states even tack on more taxes on top of that. There are many things that you can do to lower that tax if you are over it. One of them was a recent video that I put on that talked about using 529s for estate tax purposes. Another one could be a family limited partnership or using attentional defective grantor trusts. There's many things that you can do to try and lower your estate tax, but if you're a business owner, there are many things that you can do as you're building the business to make sure that when you sell it later on, or when you die and you pass money to your kids, that you're not going to owe as much estate taxes. You hear the terms CRUT, CRAT, GRAT, SLAT. These are all different trusts that you can use to lower your estate tax. And as a business owner, you can't ignore these. You have to make sure that you don't make your children pay a 40% estate tax just because you didn't want to do the planning. The sixth tax is the one that's often referred to as the behavior tax. This is the one that no one is out there talking about. And just as the name suggests, this is based on making bad decisions rather than taking action. It's things like having over concentration in both your company and in your investments. It's panic selling in your investment account or buying things that you don't need and running out of liquidity. The behavior tax is the one where you're not paying another entity. You're not paying the IRS. You're not paying a state. You're paying others and you're taking money from future generations. And truthfully, the biggest tax I see people make isn't to the IRS, it's this one. It's making poor choices that didn't have to be made and having you lose out on money that you or your generations could use in the future. So we just talked about how there's 6 taxes that every business owner is going to pay whether they know it or not. The first one is income tax. The second one is capital gains tax. The third one is net investment income tax. The fourth one is self-employment tax. The fifth one is estate tax. And the sixth one is behavior tax. Some of these are avoidable. Other ones can be lowered by proactive planning. But every business owner is going to pay these. The question is, how much are you going to pay? So if you're here watching this video, I'm guessing that you want to find ways to lower how to do these. And there are many strategies that I talked about in this video or not in this video that you can do to either eliminate or lower these taxes. The key is doing it beforehand and not doing it later. So if you're someone who wants to get ahead of the curve and you want to have proactive planning, there's a link in the description below that will allow you to go through and figure out how you can create your game plan and make sure that you keep money and not give it to Uncle Sam. If you've watched this long, I hope you got some value out of it. And if you'd like to hear me talk about anything else, please in the comments mention another topic that you'd love to hear on, and I'm happy to make a video about that. And if you want more no BS financial information for business owners, give me a follow and I'll see you on the next one.